The accounting cycle is the comprehensive process used by businesses to identify, record, and report financial transactions. It starts with transaction analysis and ends with closing the books for a period. The cycle typically consists of the following steps. 1. Transaction analysis and journalizing, recording business events as journal entries. 2. Posting to ledger accounts, transferring journal entries into individual accounts. 3rd, preparation of unadjusted trial balance, summarizing ledger balances to verify equality of debits and credits. 4. Adjusting entries, recording accruals, deferrals, depreciation, and other necessary adjustments. 5. Preparation of adjusted trial balance, ensuring accounts reflect all adjustments. 6th, preparation of financial statements, income statement, balance sheet, statement of owner's equity. 7. Closing entries, resetting temporary accounts for the next period. 8. Post-closing trial balance, verifying ledger accuracy after closing entries. Adjusting entries occur at step 4 and are essential to accurately match revenues and expenses to the correct accounting period. Necessity and purpose of adjusting entries. Adjusting entries are necessary because not all transactions are recorded daily. Some expenses or revenues span multiple accounting periods. The accrual basis of accounting requires recognition of revenue when earned and expenses when incurred, regardless of cash flow timing. They help comply with the matching principle, which states that expenses should be recognized in the same period as the revenues they help generate. Without adjustments, financial statements would either overstate or understate income and asset liability values. Types of adjusting entries. 1. Accrued revenues. Revenues earned but not yet recorded or received in cash by the end of the accounting period. Example, a consulting firm completes work in June, but will invoice the client in July. Adjustment. Debit accounts receivable, credit service revenue. 2. Accrued expenses, expenses incurred but not yet paid or recorded. Example, salaries earned by employees but payable next month. Adjustment. Debit salaries expense, credit salaries payable. 3. Deferred revenues, unearned revenues. Cash received before earning revenue, creating a liability until services, goods are delivered. Example, a company receives payment for annual magazine subscriptions upfront. Adjustment. Debit unearned revenue, credit revenue for the portion earned. 4th, deferred expenses, prepaid expenses, payments made in advance for expenses initially recorded as assets and expensed over time. Example, prepaid insurance recorded as an asset but expensed monthly. Adjustment. Debit insurance expense, credit prepaid insurance. 5. Depreciation, allocating the cost of a tangible asset over its useful life. Adjustment. Debit depreciation expense, credit accumulated depreciation. Preparing adjusting entries. 1. Identifying adjustment. Needs review trial balance for unrecorded accrued items. Analyze prepaid accounts for amounts that should be expensed. Examine liabilities for deferred revenues that need revenue recognition. Consider asset usage and lifespan for depreciation. 2. Recording adjusting entries. Each adjusting entry will have one income statement account, revenue or expense, and one balance sheet account, asset or liability. General format, debit expense or asset account, credit revenue or liability account. For example, date, account, debit, and credit 1. 30. June 2020, salaries expense, 50,000 Naira salaries. Payable 50,000 Naira. 3. Impact on financial statements. Adjusting entries ensure that income statements report all earned revenues and incurred expenses. Balance sheets reflect accurate asset and liability balances. Equity reflects correct net income or loss. Common mistakes and best practices. 1. Common errors. Omitting adjusting entries for accrued items. Incorrectly classifying prepaid expenses. Neglecting depreciation or amortization. Not closing temporary accounts properly after adjustments. 2. Best practices. Regularly review accounts before period end. Maintain a checklist for each type of adjustment. Use accounting software to automate recurring entries. Reconcile adjusted trial balances with prior periods. Train staff on the importance of accurate adjustments. Adjusting entries in automated accounting systems. Modern accounting systems often automate many adjusting entries based on input schedules, e.g., depreciation, amortization. However, manual review is still critical for accruals and deferrals requiring judgment. Real-world examples and case study. Example 1. Accrued revenue. A law firm provided 100,000 naira in services during June, but will invoice clients in July. Adjusting entry. Debit accounts. Receivable, 100,000 naira. Credit service revenue, 100,000 naira. Example 2. Prepaid rent company. Prepaid 120,000 naira rent for 12 months, starting January 1. Each month, the company will record debit rent expense, 10,000 naira credit, prepaid rent, 10,000 naira case study. Company X failed to record accrued salaries for June, amounting to 80,000 naira. As a result, June's expenses and liabilities were understated, inflating net income and equity. Correcting this adjusting entry provides accurate financial statements and prevents compliance issues. Summary. Adjusting entries are indispensable for ensuring compliance with accrual accounting, maintaining accuracy and fairness in financial reporting, enabling management and stakeholders to make informed decisions, preparing financial statements that present a true picture of financial health. Mastery of adjusting entries enhances accountants' ability to close periods efficiently and maintain reliable records.